Have you ever heard someone say their startup investment could be tax-free? They're probably talking about QSBS, or qualified small business stock. It's one of the most talked about tax benefits in early stage investing, but it's also easy to misunderstand. Not every company or investor qualifies, and there are plenty of rules and exceptions to know before counting on those tax savings. Here's the big idea. If you buy stock in a qualifying C corporation, get it directly from the company, and hold it for more than 5 years, you might be able to exclude some or even all of your gains from federal capital gains taxes when you sell. But there are limits, paperwork, and state tax differences to consider. QSBS tends to benefit founders, early employees who exercise and hold stock, and early investors who stick around for the long haul. If you're investing later, buying secondaries, or need liquidity sooner, QSBS might not apply. Always check with your tax advisor before making decisions.